Well, good evening, everyone, and welcome to tonight's Money Matters workshop on credit and identity theft. My name is Kimberly Prime, Director of Constituent Services and Community Partnerships for Howard County Executive Calvin Ball. Before we get to our speakers, just a few housekeeping items. Tonight's meeting is being recorded and will be uploaded to our Money Matters website for those that are unable to join us, or if you would like to watch this video at a later time. You can find this video along with all of our other Money Matters workshops we're hosting throughout the month of April at www.howardcountymd.gov/moneymatters. During the presentation, if you have any questions, we kindly ask that you place it in the chat box located in the lower right corner of your screen. You can also raise your hand and you will be called upon. We have also provided a sign language interpreter, which you should see pinned to the top of your screen. Following our presentation, the speakers will have the opportunity to answer your questions. Tonight, we do have three presenters that are joining us: Emily Hickox, spokesperson from CCCS MD, David Woodruff, president of APL Federal Credit Union, and Lila Bohr, investigator from the county's Office of Consumer Protection. Now I'll turn things over to tonight's first speaker, Emily. Emily, the floor is yours.
Thanks, Kim. Good evening, everyone. Thank you so much for joining us. You know, it's getting late in the evening, the sun is setting here, but this is the best time to talk about credit and identity theft. I'm very excited. But try to stay with us because we've got a lot of good stuff to go over tonight. And as Kim said, this is being recorded. And I think this is going to be one of those things you'll want to go back and rewatch and look at some of our slides again. So these are some of our objectives for the evening. We're going to talk about credit in many different ways. We're going to talk about the impacts of credit, your credit score, different types of credits. We'll talk about the credit report a little bit, and we'll talk about bankruptcy for just a bit, derogatory information, how to establish credit, and then we're going to end with some great information on identity theft. So before we get too deep into the credit report and score and all the things it impacts, just curious if in the last 60 days you have checked your credit report. And if you have and you're willing to tell us, if you could put in the chat yes or no, if in the last 60 days you've checked your credit report. All right. Well, it doesn't look like anyone has, so it's great that you're here tonight. Oh, here comes a few. Awesome. Thank you for those of you that are answering that you have or you haven't. It's very important that we talk about that and that we make talking about credit reports and credit scores somewhat of a norm, that we're looking at them often, that we understand them. So we're going to talk about a lot of great things tonight that I think will inspire you to check those as often as you can. So what does the credit score and your report impact? Well, unfortunately, and I say that because it's one of those things that we can't avoid, but your credit score does impact quite a bit. It can impact your ability to get affordable and sustainable housing, so apartment rental, mortgages that you're applying for. It can affect things like utility services and deposits. It most certainly can affect auto purchases. So if you've ever gone to purchase a car and you weren't going to pay all in cash, you likely had to finance a portion of it. And when you did that, you sat down with somebody from the bank or the lender that sits at the dealership, and they walked you through all your options. And the options that they gave you for financing were based on your credit score, what sorts of rates you were eligible for, what terms you were eligible for. Your score can also be used for insurance. That's another area where the insurance companies are looking at your score, and it can impact your auto, home, or life insurance. And it can also, in some places, affect your employment. So some organizations use your credit score and report to make hiring or promotion decisions or security clearances. But I think most of the people on the line today are from Maryland. And it's important to know that the Maryland Job Applicant Fairness Act, which is from October of 2011, it prohibits Maryland employers from using a credit report to determine whether to hire or terminate an individual. And they also can't use your credit report or your score to determine your rate of pay or any other conditions of employment. So while there are some places in the country where it can be used, in Maryland it can't. So that's good to know. And the big bold line item on this slide is homeownership. That's going to come up a lot. I mentioned that in addition to apartments and what kind of units you're eligible to get in terms, mortgages also come into play there. And we're going to talk a lot about the mortgage and what the impacts can be on your monthly payment, depending on where your credit score is. See, I told you we were going to talk about housing. Look at that. We've got some more on housing. So the credit score is really important because it's going to determine the affordability and the sustainability of your housing. So when we talk about affordability, we're talking about what kind of terms you can get into when you get a mortgage. And sustainability, can you keep up with those payments? Are you getting into a position where you have the means to sustain that housing? So we're going to talk about the credit score and what that means for rates. Now, in a perfect world, we would all just cash buy houses. It's crazy how much it's happening right now in certain parts of the country, but that's not the reality for most of us. Most of us are going to have to finance a home at some point or are already in that situation. So it's important to understand what changes in your credit score might impact your future ability to get a new mortgage or if you're looking to refinance. So before we dive too much into that, I want to just mention a little bit about the credit bureaus. So when you think about your credit score and your credit report, you may have heard these words like Experian, TransUnion, and Equifax. Those are the three big ones that most people know about. If you're interested in like really geeking out on credit scores and credit reports and identity theft, you've probably been on these websites a lot in the last few years because each of these companies has introduced all different ways to help protect yourself from identity theft and also giving you access to your score and information that you need. So we put that information up. Oh, go ahead, Dave.
One note that's really important there, Emily, is that if someone, sometimes you get the score from a lender when you've applied, it'll tell you the score, but that, as Emily mentioned, it's not always the same from place to place where you apply. And sometimes people get confused. They say, well, I had a 710 score over there. Why are you telling me my score is different? The scoring functions that they use sometimes are different, and sometimes if time has gone by, there may be just some different information on your credit report too, and it changes with that.
That's an awesome point, David. Thank you for making that. And actually just today, I was checking my credit score because I was drowning in this stuff and thought it'd be fun. And in one of the bureaus, my score had gone up 4 points, and then in another one it had gone down 6 points. I was like, wait a minute, that doesn't seem fair. But that certainly does happen where they're different. Another mention I want to make about the report, because you're going to want to get your report to help understand where you are and what's contributing to your credit score, and we'll help you dissect that in a little bit. But there's a website called annualcreditreport.com. And if you haven't been there, go there tonight. Not right now, because I want you to watch this presentation, but later, go there and check it out. And usually you're entitled to receive one free credit report every year. And you can get them more frequently if you fall into certain situations. So if you've been denied credit within 60 days of that denial, you can request your credit report for free. You can also, if you're unemployed and you plan to search for a job within 60 days, you can request it then. If you're on welfare, or if you find inaccuracies that may be due to fraud and identity theft, you can request the report for free. But There are some positive things that came out of the pandemic, and one of them is that you can get your credit report right now every week for free. And that was something that was started early on in the pandemic and has continued, and I believe it's continuing for a long while. I think it's through April of next year. I think they made it a nice long time span. So if you take advantage of that, take a look through your report, and it will give you everything you need to understand what's contributing to your score. All right, so thinking about mortgages, or if you've purchased a car recently or looking at that, you've probably heard a lot about interest rates. And the buzz on the street right now is, oh, this is a great time to finance because interest rates are low. Well, yes, interest rates may be low, but that doesn't mean we all qualify for those really low rates. So we want to understand, how does our credit score factor in to the rates we're going to get when we want to finance something? So if you have a high credit score, that tells a lender that you're less of a risk, meaning it's not likely that you'll default on payments, and it's more likely that you're going to make your payments on time and you're reliable in that way. So that makes it easier to get a lower rate. Now we're going to do some math later. I promise it won't be too much. But when we do a little math in a bit, you're going to see that the lower your rate, the less you spend on the loan, whether it's a mortgage or an auto loan or a personal loan. Now, if you have a lower score, that tells the lender that you're more risky, that there is a chance you may not be able to make your payments, that you may default in some way, and they have to find a way to assume that risk, and that's by giving you a higher rate. So again, you'll see the inverse. When we have a higher rate, financing costs more. You end up paying more in interest over the life of the loan. So the goal is high scores and low rates. All right, I'm going to keep this slide up for a little bit while we talk, because I know this is kind of an eye chart, but it's good to look at and get an idea of the ranges. So these are the ranges of a credit score. And you want to know what's your score and what bracket do you fall into. A lot of the websites where you can check your score, I know like Credit Karma, they have those fun dials that move and tell you where your credit score is. I think that's more fun than the sliding scale, but it's really hard to make a dial in PowerPoint, so we went with this. But the credit score has all these different ranges. We've got poor, fair, good, very good, and exceptional. And I want to talk a little bit about what each one of these means. And we'll start with the highest. So if your credit score is 800 plus, that means you have exceptional credit. This means that you're way above the national average, and lenders, they're going to think that you're not going to have a problem paying on your debt. You're going to be able to make your monthly payments on time. You may even pay them ahead of schedule or put more towards your principal every month. You're a good risk to them. So you're going to get a really good rate. About 1% of consumers with credit scores of 800 or higher are likely to become delinquent on payments. So again, very, very low risk to the lenders there. The next category is very good, and that's where your score ranges from 740 to 799. And in the very good range, this is also above the national average, and you're going to get a pretty good rate in this range as well. This shows the lenders that there's a high likelihood that you're going to pay on time. In this category, the risk to lenders is that about 2% of consumers with these credit scores are likely to become delinquent. So again, in the 800 plus, there's a 1% chance. In the very good, there's a 2% chance. We start to take more of a jump as we go down in the categories as far as the chance of delinquency, which kind of gives you some idea of why the rates fluctuate so much depending on your credit score. So in the good range from 670 to 739, this is a good median. This identifies you as acceptable. It means that you might not get as low of an interest rate as the very good or exceptional category, but it will still be a median fine interest rate. For this category, about 8% of consumers with credit scores in here are likely to become delinquent. So we went from 1% to 2% to 8%. Then we have the fair category. And the fair category is where we start to talk about how do we improve your credit score, because this is where we don't want to be. We don't want to be in the fair and lower, because that's going to cause you to, again, get those unfavorable lending terms. So in fair, your credit score is between 580 and 669. And this is below the national average. So this is going to say that you may have a more difficult time paying the loan on time, and you will end up paying a higher interest rate than those with better credit. In this category, the risk is considered medium to high for lenders, and about 28% of consumers with credit scores in this range are likely to become delinquent. So that's a really big jump, right? We went from 1 to 2 to 8 to 28. So we took this really big leap to the risk to the lender. And the last category is poor, so that's 579 and lower. And consumers within this range are considered a poor credit risk, and they may be, they'll either get very high interest rates or they may even be rejected for a loan. Many people who fall into this range may have to put down a deposit or a fee to obtain a credit card, or perhaps get home utility services if the utility company is running your credit. Now in this range, this is considered the high risk for a lender, because about 61% of consumers with credit scores in this range are likely to become delinquent in their payments. So again, the biggest jump we've made so far, right? We went from 1 to 2 to 8 to 28 to 61. So you can kind of get an idea of the lender's perspective. I know sometimes when I'm frustrated with the situation I am in, I try to take the view of the person on the other side of the table. And this is a great example of that, is trying to understand where the lenders are coming from. Speaking of which, David, did you have anything you wanted to add to this slide?
Sure. You know, I think the thing to remember is that when these are odds. So if you have a low score, it doesn't mean you're not going to pay your loan. It just means that out of 100 loans that we make in that, say, under 579 score range, 39 people will pay and 61 won't by odds. We just don't know which ones they are. So as a result, there's higher rates maybe that are applied, or other terms. Maybe you have to put more down payment in a situation to be able to get the loan, or you need a cosigner or something like that to shrink the odds that you're going to have trouble with the payment. So, and not all lenders do that. You know, our credit union, we don't actually change the rate based on score. If we approve you, we give you the same rate, but most do. This applies to most lenders, yeah.
Thanks, David. Are there any questions on these ranges? I can't see the chat. Is there anything before we move on?
I haven't seen anything in the chat yet.
All right, great. Thanks, David. All right, so I mentioned that we were going to do some math, but the good news is it's done. It's all on the slide. Math is done. We don't even have to take out our calculators. I have one just in case. If you want me to make up new numbers, we could do it a couple of different ways. I'm good with that too. So how can your credit score save you money? I mentioned, and David mentioned as well, that your credit score is going to dictate and highly impact what interest rate you're going to get. So for this example here on the slide, this is a $20,000 loan for 5 years. So let's assume you went out, you were trying to get a $20,000 loan over the 5-year term. If you had a very good credit score in the 700 to 749 range, you would get, in this scenario, an interest rate of 3%. So that's really good, right? Really low. But if you look on the column to the left, if your score is from 550 to 599, you're gonna get, excuse me, not in credit score, an interest rate of 18%. So we're talking a very big difference in the percentages. So what does that mean for your monthly payment? You can see that your monthly payment is going to be $149 difference. So in the lower credit score category, when you have a higher interest rate, in this scenario, you would pay $508 a month. In another scenario where your credit score was very high and very good, you would have a payment of $359 a month. Now let's look at the next line, because the next line talks about total interest. How much interest are you paying on that $20,000 loan over its life? And with the 18% interest, you're going to pay $10,480 in interest. But with the 3% loan, you're going to pay $1,562. So while you might say, it's okay, I can afford, $149 difference, that's not that big of a deal. But when you look at it in totality, $8,918 is a very big difference. So you kind of want to keep that in mind. One of the things I always tell mostly friends when they go to buy a car is I say, don't worry about the monthly payment. Stop negotiating a monthly payment. Worry about the full price of the car, what you're going to end up paying, and the interest rate. The monthly payment it's not what you need to worry about, because this is why. Because at the end of the day, you need to know, what are you actually paying for that loan. We're at my favorite chart. I could sit here all day. I will try not to. I should bring my glasses.
Sorry about that. I was just responding to one of the chats, Emily. On this, there was on this chart. Were you ready for my chime in on this one? I apologize. I was responding.
This one here?
Yes.
Oh yes, please go ahead. I haven't said anything yet.
Oh, okay. Sorry. Apologize for getting distracted there. What Emily's going to go over is the things that make this up. And as you're doing this, think about when a lender is looking at your credit, what are they looking for? And these things kind of determine the weight that the lender would probably be putting if they were considering you for a loan. What factors go into it? And so as you go through this, think of that. This is kind of represents the way a lender would look at, are you qualified, or are you a good risk or a more difficult risk?
Thanks, David. Yeah, this is a great chart, because one of the things that I know can overwhelm folks is when they find out that they have a low credit score and they want to improve it, even if it's a good credit score and they want to improve it. It's hard to know what to do. How do you improve your credit? And knowing is the first step in the battle, knowing what makes up your credit score, because knowing what is in there is going to help you shift things. You can decide, okay, where can I have some impact here? What can I do to influence these factors? So these are the behaviors that they're looking at that comprise your credit score. So the biggest part of this chart here is the payment history. It is 35%. And the good news is that it's the easiest thing on this chart for us to influence. We can control our payment history. Now, I know there are going to be situations where we're facing financial crisis where our payment history isn't what we want it to be, but we do have the most control of this section. So when you think about payment history, I want you to know that it doesn't matter how much you pay, as long as you're making your minimum payments. So if it's a mortgage, you obviously have to pay the full mortgage amount. It's great if you pay more. Very good practice to do, to try to put a little bit more each month towards your mortgage. But if not, as long as you're paying your statement amount every month, you're in good standing as far as this metric is concerned. Now with a credit card, you'll usually have your statement balance and your minimum payment. You want to make sure that you're paying that minimum payment no matter what. Even if you can only pay the minimum payment for months at a time, that still shows that you're able to meet your debt obligations, that you're consistently making payments. So do everything you can to make those minimum payments. And when we do, when CCCSMD does webinars and coaching on financial crisis, we talk a lot about that let's really focus and make sure that, we're keeping a roof over our head and food on the table, but that for our debts, we're at least making the payment to keep our credit score in good standing. So the second behavior I want to talk about here is the amounts owed. So the amounts owed accounts for 30% of your score. And this is looking at how much do you owe as a percent of your total available limit. So if you're maxed out on your credit cards, that's going to have a more negative impact on your score for this category than if you only were using maybe 15 to 20% of your credit limits. It's going to look at this on each of your accounts, and it'll also look at it as a total. And when it looks at the total, it looks mostly at types of credits altogether. So it'll lump all your credit cards together and say, you're using 50% of your available credit. Now, this one's a little bit harder for us to control, but we still can control this. We can control what percentage of debt we're using by, if you're looking to improve your score, paying off debt as much as you can. Obviously, bringing that balance down will help. And one good practice to do is, if you're really trying to make a dent, is put one of those credit cards away, hide it, lock it up, whatever you got to do. But having at least one that you can pay off and bring the balance down, close to or at zero, will really help this ratio and have a positive impact on your credit score. So we're going to kind of jump around the chart a little bit, but we're going to talk about types of credit used. So what's your mix of credit? And this is going to account for 10% of your score, or of what's considered in your score. This is going to look at the number of banks you have accounts with, the number of credit cards, if you have installment debts, or different types of revolving debts. It's going to take a look at that mix. Do you have a mortgage? Do you have an auto loan? And the mix is actually good. Having a good mix shows that you can handle different types of debt. And I'll kind of repeat this a few times, but just keep in mind the credit score is all about how do you handle debt? How good are you at being in debt? So that's what they're looking for there, is if you've got these various types of debt, student loans, mortgages, credit cards, are you keeping up on all of them? And it likes to see that you have a mix that you're keeping up on.
And let me just add to that, it's not that you have to have them all at once. It can also be that you've taken care of it and it's passed, but it's still, it stays on your credit report as a past history as well, that you dealt with it, but you don't have to keep taking out all these various types of loans all at once.
That's a very good point. Thank you. Definitely don't do that. I don't want anyone going out and saying, oh no, I don't have a student loan, I better go get one. Absolutely. Right. It's not a good idea. It'll also look at the length of credit history. So that makes up 15% of the score. And how long have you been using credit? So I remember, when I had just come out of college and I had just gotten my first credit card and I maxed it out really fast, and yeah, that happened. But I remember having, a fairly low score and saying, well, what's contributing to this? And when I looked at my report and sat down with someone, they said, well, you've only had credit for like 18 months, so you're not a good bet. So the longer you have credit, it shows that it does show that good history, and that's something that they want to see, the longevity. Mortgages are certainly the best way to get a long credit history, because typically they're 15 to 30 years. So as long as you're keeping up with the payments, well, that's going to have a positive impact. And then the last section on here is new credit. So what's available for new credit? How many accounts have you opened in the last few months? In the last 12 months is what they really look at. But again, another horror from college is when I got my first job after college, I needed clothes. Like, I had to look like an adult for the first time. So I went and got 6 or 7 department store credit cards and bought a whole new wardrobe. And that was not a good thing for for this part of my credit score. The new credit was having a bit of a heart attack, and it drove my score down for a bit as well. So things that I did not think about that are really important to know, that it's okay to establish new credit, and there's certainly going to be times where you need to, but just be prepared that when you do that, you may see a drop in your score.
Emily, let me add in here that there's really no shortcut to establishing credit. It takes time, because what you're establishing is, think of it as a reputation. When you were a kid and you borrowed, $1 from your friend, If you paid them back, you're establishing a reputation, and they would probably lend you $1 again. But if you didn't, the next time you went to them, they'd say, well, gosh, you didn't pay me back last time. I'm going to rethink this. Well, in the broader world of this, it takes time to establish that history. And so this is a makeup of all of that, and there really isn't a shortcut to it. It takes time. And so this new credit one, sometimes when you get, maybe you get a student loan or something like that, you have maybe a department store, and then you start getting offers in the mail from credit card companies.
Yeah.
And if you start accepting multiple offers, what's happened now is you're becoming a big risk because the lender has no idea. What are you going to do with all that? You don't have any track record with handling that kind of debt. And so that can really be detrimental for you establishing responsibility. And so actually in a measured way, adding on a card, letting time go by, adding on another card. If you're preparing for a purchase, just start early. That's the secret, is start early in establishing this, so that, because there just isn't a shortcut to all of a sudden make your score better. And if you hear people promise you shortcuts, they're usually too good to be true.
Absolutely. And I'm so glad that people are watching this webinar, and hopefully we can share it more, because you do hear a lot of quick fixes, or for those that don't have credit yet, you'll hear folks tell them, oh, just open a bunch of cards, or, go get this loan, go do that. And it's important to, get some advice from the folks that have been doing this a while, like David, that really know what can you do to help your score. And certainly opening a bunch of, H&M and the limited cards was not the answer. And David, where were you? I mean, why weren't you there to help me? So the score is really interesting, and everybody loves the score. Everybody wants to know what their score is. I have a girlfriend, she's divorced, she's looking to get back into the dating scene, and she asked me, what should I be asking guys that I meet on, Match.com or whatever? And I said, just ask them their credit score and everything will be okay. But that's not true. Don't do that. But in addition to the credit score, what's behind that is really important too, and that's the credit report. So if you haven't looked at that credit report, definitely go do that. There are services out there like that CCCSMD offers and others offer to walk you through with you and help you understand what's in there. And it'll go over your ID will be in there, employment information is going to be in there, your payment history, any sort of revolving or installment debt. You're going to have some ratings, public records, and inquiries. And I'm going to dive into each of these just a little bit. So one of the things when we're talking about the credit scoring and what goes into that, and we mentioned all these different elements of your credit history. Well, obviously on that report is going to be everything about your accounts. You're going to be able to see your open accounts, your closed accounts. You're going to be able to see for each type of credit, for each line of credit that you have, you'll see they call it a trade line, and you'll be able to see a lot of different information about each account. There's over a dozen items that it'll show you. You'll be able to see the date the account was opened. And so that's looking at the length, right? It's all making sense now. You're going to see when the reported date is. So one of the things David mentioned is that your credit score may be different from each union, from each bureau that gives you your score. One of the reasons for that could be the date it was ran. So we want to know when it was ran to see if anything impacted it. This week, my mortgage company, or a couple of weeks back, sold my loan. I can't stand when this happens because I have to change all my auto pay information, but they sold my loan to another company. So on my credit report, it looks like, oh, I closed my mortgage, but the new loan doesn't show up yet. So right now it looks like I have a paid for mortgage, which is amazing, but it's definitely not true, because if I run the report in a couple of days, I'm sure the other one will show up. So it'll show the balance, what's outstanding versus what your credit limit is. It's going to show your monthly payment or estimated monthly payment. And it'll show the highest amount you've ever owed. And any past due amounts will be on there. again, your credit limit. And then there's a payment grid that's going to show you the 24 months of payment history. So that payment history, like we said, it's 35% of your score. It is really important. So it's gonna have indicators of whether you made payments in that month, or if there was no history reported for that month. There may be an X there indicating that. And it's going to break down into 3 buckets how many days late you've been on that debt. So there'll be a number of how many times you were 30 plus days late, 60 plus days late, and 90 plus days late. So that there's a lot of that report that focuses on that payment history. It'll show the terms for the installment accounts that you have, and it'll also show whether the account is in collections. That will be on there as well. Joint accounts may be there, and co-signer accounts will also show up on there. Now, there are some public records that are going to appear on your credit report, and that's from different government sources. And there could be a judgment, a lien, bankruptcy, or overdue child support. Those are the ones that you'll typically see show up. And inquiries, we're going to talk in just a second about the different types of inquiries that the different types of pulls folks are doing on your credit, and those will show up as well. All right, so let's talk a little bit about a hard pull versus a soft pull. I don't know if you've ever heard anybody say that and thought to yourself, I have no idea what that means, or, you know, is a soft pull okay? You know, a lot of people worry about that. So let's just define that and talk about what it is. So a hard pull is when a lender is pulling your credit score and your credit report for the purpose of extending you credit. So they know that you're applying for a loan, and they're going to pull the report, and it's going to appear on your credit report that they did that they pulled the report. Now, anytime you have a hard pull, that can have an impact on your credit score. Typically, you know, in my experience, I've seen it's gone down, you know, a point or two. It's usually not that much, but it can bring the score down a little bit. And when you're working really hard to rebuild your credit score, going down any amount can be difficult. So you want to make sure you're ready for it and you know that it's going to happen. Now, a soft pull is when they're pulling for information only. So they're not going to extend you credit, but they want to know what's happening behind the scenes and, you know, what your credit history is like. So this is actually happening. I believe one of the ways it's happening is when you do get those offers in the mail that David was talking about. They're doing some soft pulls and seeing if you're a good candidate to send all this horrible mail to. I don't even think we should open mail anymore. I'm over it. But that's one of the areas that it can be used for. And the soft pulls may not appear on your credit report. Now, what happens if you are shopping for a major purchase? We're talking about a house or a car. Let's talk about those 2 big things. So when you're doing that, it's always wise to shop around for rates. Now, obviously, I'm going to go to David first because he seems like a pretty good guy, but you want to shop around a little bit. You want to find out, you know, which lender is going to give you the best terms. Perhaps you're part of, if you're part of the military, you may want to try USAA before you try anything else. You may have some things that you have access to that others don't. When you're shopping for one thing and you pull your credit multiple times, you have your credit pulled multiple times for that one purchase, it counts as one pull. So there's a 45-day window where 5 or 6 lenders, however many you choose to shop around for, can all pull your credit report, and it will only count as one hard pull. So that's really important to know because we don't want you to be afraid to shop around. It's important to do that and really understand the terms and be comfortable with the lender you're going with. So know that in that 45-day period, it's all just one pull. All right, so I want to talk a little bit about derogatory information. This is kind of a bummer slide, so we'll move through it kind of quickly. But there are things that we're going to run into in our lives that we don't want on our credit report, but it's going to be there. And they're just part of what we've gone through in our journey. And it's important to understand what's going to be on there. So basic negative information. that's going to stay on your credit report for 7 years and 6 months. It's a crazy time frame, right? I don't know who makes these up, David. If it's you, you got to change it. It's crazy. Foreclosures and short sales, that'll stay on for 7 years. Discharge Chapter 7 bankruptcy, 10 years from the filing date. That's a long time. So make sure that you really understand that and what the implications are. We'll talk a little bit about bankruptcy in a minute, just making sure before you get into that, that you know what it's going to do to your credit score in your report. A discharge Chapter 13 will stay on for 7 years from the filing date. A dismissed 7 or 13, 10 years from the filing date. Any judgments are going to be 7 years, and it could be longer, and depends on the statute of limitations and what the judgment is. Unpaid tax liens, 15 years. Guys, taxes, they always get us, no matter what. It's always the worst. It's the worst on this chart. Sorry. So 15 years for unpaid tax liens. Unpaid student loans, 7 years. Now, there's a few things that are not subject to any statute of limitations and could stay on there for much longer. And that's going to be federal student loans, most types of fines, and then past due child support. For the child support, that varies by state, and then taxes, because again, taxes. Sorry, that time of year. All right, so I promised we'd talk a little bit about bankruptcy, but I'm conscious of the time, so I'm going to talk a little quick about this. But bankruptcy is something that, you know, it's definitely not something we want to get into, but it is an option for debt relief, and it is something that can be used as a tool for folks to get a fresh start and to be able to get out of a really difficult situation. So there's going to be times where bankruptcy makes the most sense. And this is kind of the life of bankruptcy and the process. So you make the decision to file. There's credit counseling that you're required to go through. And then once the bankruptcy is filed, you do have to go typically to debtor education. Now, there are limitations on the types of bankruptcies you can use. The two primary ones for consumers are Chapter 7 and Chapter 13. So with few exceptions, any individual contemplating bankruptcy is going to have to go to that credit counseling. They're going to do that within 180 days prior to filing. And then there's additional counseling, again, called the debtor education. That's required before the debts are discharged. Now, which type of bankruptcy you file is based on a means test. And that's when the court's going to make a determination if you're eligible to file Chapter 7. And it's based on your ability to repay a portion of the debt. So the means test is you know, much better explained by legal counsel than by me. But you know, some general information I can give you is that it's permitted if the combined monthly income for the client and their spouse is less than the median income for families in their state as adjusted for household size. That's a lot of words for 7:45 at night, just saying. But if Chapter 7 is not permitted, then you would go into looking into Chapter 13. That's also called a wage earner plan, and that's where you're paying back the debts over usually a 3 to 5 year period. So I'm not going to dig into bankruptcy too much in this course, but just want you to know that when you do file bankruptcy, there, as we saw on the previous slide, there is an impact on your credit report. It will remain on there for 7 to 10 years. Oops, sorry about that. I got a little trigger happy. All right, so quickly about disputes. So if you have something on your credit report that you don't know, you've got this line of credit that you cannot figure out, and you don't remember opening this account, you certainly don't remember charging, you know, $20,000, whatever it might say you owe, then you want to file a dispute. And we can do this online, we could do it by mail, and there's a lot of information that's needed when you do file the dispute. Mostly just personal information that you likely know off the top of your head, but you do want your credit report in front of you when you're making this dispute. So if you're going to do it online, which is obviously going to be faster and a little bit easier, you want to make sure that you are following the directions very carefully. I believe each bureau has their own way of doing this. So you just want to make sure you're accessing the credit bureau site and reviewing the process they have in place. One of the things we tell people is make sure you're adjusting your spam blocker or email settings, because sometimes responses from the credit bureaus can be blocked. So you want to look at that. And whenever you're doing this, keep documentation. Make sure you're saving everything, preferably in like a folder on your computer. Just save everything in one place so that if you have to go to all 3 credit bureaus, you've got all the information together, or if you have trouble just with the dispute, you've got it readily available. This is a sample dispute letter. I'm not going to quiz you on this, so don't worry about it. But just know that when you do want to dispute in mail, there are sample letters out there that you can use. But basically, you're just letting them know that, hey, I reviewed my credit report. I found this thing that's inaccurate, and I would like it either removed, updated, or corrected. So you want to put in there what action you're seeking. All right, we're up to David's favorite part. I know it. We're up to building credit. So, so having no credit on record is really tough. And I personally struggle with this one so much because as a mom, I definitely don't want my kids getting into debt, but I also don't want them not having the ability to get affordable housing as they get older. So this is a very tricky one. So without credit history, it means that the lenders will have no credit record to review, and it's hard for them to make a decision. So I'm going to just bring up some of the things you can do if you don't have credit history to start building that. And then David, please jump in with any tips you have on each of these. But the most important thing is being consistent. I think that's the most important bullet on this slide is whatever you decide to do, don't do 6 or 7 things at once. Like David said, don't open a ton of new credit cards or apply for a ton of loans, but pick a course of action and then really stick with that. So on here's a couple of things you can do. But David, do you want to say anything about those with no credit history?
Yeah, let me just add it. This first one, establish banking relationships. When you have no credit history, choosing a local institution that has, a branch in your community, they are going to be much more connected to understanding, you as a local person. But, open up a checking account and get direct deposit of your paycheck going to that institution. When the lender looks at that, they'll look at that as a stability factor. Now, if you set it up this week and next week you apply for a loan, it doesn't mean a lot. The consistency thing, we need to see it coming into the account over time. We say, okay, that person's with us and we can count on their paycheck coming, and so they're likely to pay their loan. Or you don't overdraw the account, kind of the basic things of taking care of it. And then the other thing that you can do is if you're thinking you want to buy a car, decide the payment you can afford, and then each month make that payment into a savings account with that institution. And then when you go to apply for credit, say a year down the road, you can say to them, hey, look at my savings account. Every month I put a deposit of $340. I've been making a payment to myself. That'll become your down payment probably on the car as well. But save the money. In other words, leave it in there. You can't keep pulling it out each month and put it back. But, but show that you can handle that amount of money going out of your monthly budget, and you can still make ends meet and have good credit. So those are the tips.
That last one's fantastic. Thank you so much. I'll be instituting that with the kids right away. Maybe not right away. They're a little young, right? Thank you so much. All right, well, now we are going to move on to identity theft, another super exciting topic for this late at night. So I'm going to turn it over to Lila Bohr, who's going to take it from here.
Since it's getting late, I'm going to make this brief as possible. Identity theft. Anybody can be a victim of identity theft, from children to older adults, and believe it or not, even deceased people can be victims of identity theft. And these thieves will steal personal information because they want to steal your money, or they want to obtain goods and services in your name. Next. Identity theft involves acquiring key pieces of personal information, such as and including your name, date of birth, your social security number, a driver's license number, and or your mother's maiden name. Next. And how would they steal this information? Well, they can do it the old-fashioned way. They can steal your handbag, they can steal your wallet, they can steal your mail out of your mailbox. They can obtain it through scams occurring by the phone, email, or social media. They can also go through your trash or recycling, or they can obtain information that you have shared online, or they can purchase information from inside sources. They can approach employees of financial institutions or other places where they may find a lot of personal information and pay someone to give them your information. The biggest way they do it now is hacking into computer databases. And they can also get stolen employment and other records as well. Now, how they use your information? Well, one thing they can do is if they have your existing credit card, they can run charges up on your existing credit cards. They can also, which is even much more dangerous, is when they open new accounts in your name by way of obtaining loans. They can get a car loan. They can get any kind of loan that you can get. They can pay utility bills, they can get cell phones, they can get medical treatment, they can also commit tax ID theft and obtain a tax refund in your name. And they could also use your name and personal information to commit crimes, criminal matters. So how do you minimize your risk from becoming a victim of identity theft? Well, since it's almost impossible because of all the data breaches that occur, but the things that you can do would be to secure your wallet, your handbag, anything that's containing your personal information, shred all pre-approved credit applications that you might get in the mail, shred up all your bills or receipts or any other documents that you have with personal information, put them to the shredder. And do not carry your Social Security card. There's no reason why you would ever need to carry that card with you. So don't take it out with you. And also, you should secure your passport and other financial records in a safe place. And when getting phone calls or going on the internet, or getting things in the mail, be very, very careful as to who you're giving out your personal information to. If you don't know a person who's calling you on the phone or someplace you're clicking on the internet, or you got some strange thing in the mail, do not be free to just go out and give your date of birth and your social security number or anything like that to anyone that you do not know. So you should also carefully review your medical benefit statements, make sure there's no errors. You respond immediately to any kind of written notice or verified notice from the IRS. Do not, you call them on your own by the phone number that you find, not by something someone's given you. A good way to minimize your risk is also to obtain your credit reports at least every year at annualcreditreport.com, like Emily stated earlier. And you should take a look to make sure that all the accounts on your credit report are yours. And if there's anything that isn't yours or seems suspicious, you need to start to dispute that right away. So a social security number, keep it in a safe place, a safe location. This is a number that does not need to be given out as often as you think it does. You may see it on forms just because people put it there, but it doesn't mean you need to fill it out. You need to put it in. I many times just don't put it in. You can go to a doctor's office, for example, or somewhere, and you see a form and it says social security number. Don't put it in. If someone wants it, they could ask you, and then you could ask them, why do you need it? How are they going to use it? How are they going to protect it? And what happens if you don't give it? Sometimes you have to give it, but I would try to leaving it blank on a form if possible. And I know I've done it many times and no one has ever asked me for it, other than when it's really important. Just be careful about that because that's not a number that everybody, just because they stick it on a form, needs to have. So protect your mail, outgoing mail. Don't put up the red flag. Believe it or not, people do steal mail. They do drive around. They do look for those red flags. If you're getting incoming mail, make sure you get it out promptly. If you're getting sensitive mail and you're not home to get it and you don't have a locked mailbox, you might want to consider using a post office box to secure things like checks or statements that come through the mail. And also pay attention to your billing cycles, because if you didn't get a bill, it doesn't mean you don't still owe the money for the goods and services that you're getting billed for. But that could be an indication that someone's tampering with your mail if you don't see those statements coming regularly. So it also does negatively impact your credit score. Someone getting new loans or new credit cards in your name, and there's debt building up. Well, that's not good for your credit score. They can also make existing charges to your accounts, to your existing accounts you may not notice. Collections that are not disputed will affect your credit report if someone sends your debt to collections. And new inquiries can also drop your credit score. If somebody goes to purchase, let's say, a car loan, and they run you through it with the credit bureaus, every time you get an inquiry, that can drop your credit score. So protect yourself online. When you make purchases, make them from secure websites. Beware of phishing emails. Phishing emails are when you get an email that looks like it could come from a reputable source, such as your bank or some place that you think you may know. Be very careful. If someone sends you an email that from a financial institution, such as your bank or whatever, make sure that you do not respond to that. These kind of places do not send emails asking for your information. They already have your information. So if you get an unusual email, check it out by your own sources to make sure that it probably is illegitimate, so you do not respond to it. And
can I just add in here?
Sure.
One of the terrible scams we've seen recently is phone calls coming to people in our community where the scammers are able to spoof the caller ID so it looks like the caller's coming from your financial institution.
Yes.
Never give your passwords to somebody who calls you on the phone. The institution, we don't want our employees to know your passwords, so we will never ask you for your passwords over the phone. But scammers are doing that. Sometimes people fall for it thinking, oh, there's a problem on my account and they need to fix it. So don't fall for that one.
Yeah, and they spoof phone numbers all the time. It looks sometimes like it's coming from a sheriff or coming from the county government, or like you say, from your bank or whatever. Yeah, always hang up, verify on your own. Do never trust any of these people that are calling you, coming emails, any of these various sources that we mentioned. If you get an email from an unknown source, don't click on any hyperlinks or attachments. Don't click on pop-ups, and be careful when choosing passwords. Try to keep your computer as secure as possible. So protect yourself on social media. A lot of people put out way too much information on social media. Just be cautious, read the privacy policies, be cautious about invitations to connect with other people. And don't go ahead and post your date of birth or personal information on Facebook or Twitter or wherever, because the less people know about you, the better off you are. A lot of people post way too much personal information out there, that they're married, where they live, all kinds of pictures of things. That really, try to keep your personal information to yourself, because you really don't know who's looking at it. And if you are a victim of identity theft, the first thing you should do is file a report with the police department and get a case number. It's very important moving forward. Get your credit reports at theannualcreditreport.com. That's the only reputable source that we recommend you getting your credit report from. You need to contact if you get stuff from the credit bureaus have inaccurate information, it is on your credit reports. Make sure you contact them to remove it immediately or dispute it. You could place a 90-day alert on your credit files with the 3 credit reporting agencies, Experian, TransUnion, and Equifax. And you can contact creditors, financial institutions for all accounts that have been tampered with or fraudulently opened. Just close accounts that you did not open. Dispute fraudulent charges in writing with your creditors. Report stolen checks. You should put PINs or passwords on all accounts. You should also take a look at the Federal Trade Commission. They have an excellent abundance of information for victims of identity theft that can help you tell you what to do. And that you're going on to the Federal Trade Commission, they will tell you to fill out a report, and then they will tell you, they give you sample letters. They can tell you many different steps to take. If you get checks that are stolen in the mail, make sure you contact the U.S. Postal Inspection Service, because they are responsible for a crime that comes through the mail. So you want to make sure that you report any mail that's stolen, or checks or anything like that that's stolen. And the biggest thing you can do if you do not want a victim of identity theft is to place a credit freeze on your credit files, or what's called a security freeze. That means that you have to contact the 3 credit reporting agencies. I'm not sure if you can, I think you have to contact 3 separately. And what you're doing is you're putting on a freeze on your files. It does not affect your existing credit cards at all. It has nothing to do with that. It just protects the information collected from the credit bureaus. That's what your credit files actually are. So that means no one can put an inquiry on your credit. No one can obtain a loan in your name. No one can get any credit issued to them because you're going to put a PIN or a password or something on there to secure it. It's free. You have to do it to each one. It's free. If you want to lift it, you can lift it if you know you need to obtain credit from someplace. You can lift one of the freezes with one of the places where someone's going to run you through and do an inquiry, and then by federal law they lift it, and 3 days later your credit is open. Some of your files can be looked at, and then someone can put an inquiry on your file, and then you pay $5 and you put it back on again. And it's a little bit of an inconvenience if you're looking to get a loan. However, it's the best thing out there to protect you from identity theft. The best thing going, because most of the time identity theft is a financial crime and people looking for getting goods and services in your name. And you can opt out of pre-screen. I'm not sure how many of those are still going around. The pre-screen credit offers, they used to go around in abundance. You can opt out of them. You can also register with the do not call list to try to minimize some unwanted calls. However, these robocalls that keep coming through, and it doesn't. A lot of people claiming it doesn't really work so well anymore due to the robocalls.
It cuts out the legitimate ones, so then any of the unknown callers you get after that are illegitimate.
Right, and also, use your answering machine. Don't pick up the phone if you don't know who's calling you. You can apply to services like No More Robo, but you have to pay. It's supposed to minimize robocalls. I know they're a nuisance. We get many calls regarding this. People do the robocall business, but it's something where you just kind of click your phone on and off and get rid of it yourself. But don't answer the phone to people that you don't know. Anybody have any questions?
Well, and I will just add, before we get into the questions, we had a wonderful Money Matters workshop on Monday about preventing scams and shams. So we did certainly talk on some really great helpful information, but I would certainly encourage anyone that has any questions or would like to watch the video to check out our Money Matters website for Monday's session. That was April 19th at 7 p.m.
Yeah, and Lila mentioned the Federal Trade Commission's website. If you visit their website, they have amazing information on all the scams that are going on. They frequently write blogs and post articles helping you understand what the current scams are and how to avoid them. So I go there a lot to share information with our clients.
And if anyone is a victim of identity theft, they can call the Office of Consumer Protection. We can counsel you on what to do, what not to do, refer you where you need to go, and try to help you in that regard as to giving you some consultation if you are a victim.
And Lila, would you mind putting your information in the chat box to everyone?
Kim, do we have time to answer a couple questions that were in the chat?
We do. I know typically we end at 8, but we certainly started a little late. So, we're happy to continue recording and going live until we answer your questions.
I think there was 2 good questions that came through. One was, is there a limit to how many hard pulls you are allowed that is safe? Emily, do you know that number offhand? I believe on the credit report, it impacts you if you have more than, I think it's 3 in a 6-month period, it begins to affect your score. It's not a death knell to your score or anything like that, but if you're getting one applying, it doesn't affect you to have 1 or 2 pulls. But it is, and certainly as Emily pointed out, if you're shopping for a car and you go to 3 dealerships and they all pull your credit, that is 1 credit pull. If you're doing that in a short period of time, 45 days, I think it is. Or is it 15? Am I wrong on that number?
Well, actually, I did actually have a question, and I put it back to you. I'm looking to refinance my home, and I know Emily had mentioned 45 days, and I would be very curious. When I contacted my lender, they had mentioned 15 days, but that just helps me from a planning purpose. And then for those certainly that are tuning in that are interested in either refinancing or anything that impacts a credit pull, that would be good to know.
Yeah, and I honestly don't know. I have 45 in the notes to the presentation. It may have changed recently that I don't know about. So I will research that and get back to you.
I think 45 sounds right to me from my past. So, like you said, if it hasn't, unless it's changed. The other question was, what's the impact of debt to income ratio on loan approvals when credit score may be very good to exceptional? It definitely is a big deal. Your credit is only one portion of a lender's decision. The other is your capacity, your ability to make the payments. And so they're looking at how much debt you carry and how much income you have, and do you have the capacity? Your character or your credit is the other part of it. And so your debt to income, I would say, is huge as far as the impact on your approval. And typically, we look at gross income, and typically, I can't say this for all lenders, the number that lenders like to see is less than 34% of your monthly gross income going to pay debts. Now, many lenders will go up to 40 or 45% for certain things, certain types of things. Some lenders don't put a lot of weight. Some credit card lenders don't do a lot with the credit score. They do it very heavily on just your credit score and the amount of income that you have. So they figure if you have $100,000 of income and you have good credit, we're figuring you're going to be good. We're not going to go through actually calculating a debt ratio. But most lenders, yes, it does have a big impact on your ability to get a loan. There was one other question earlier that someone asked about the Community Reinvestment Act and the impact on getting loans. That really is a rule that governs banks, but it does have an incentive for banks to make loans in the communities where they take deposits. And so that's one of the reasons I mentioned earlier if you're looking for a loan, oftentimes you have a better chance with a lender who has a branch in your community because they have an incentive to make loans in the communities they take deposits from. It doesn't mean individually you're going to get your loan. It just means that institution generally is trying to make loans in the community they have a branch in.
There's a question of what sorts of scams do you see the most?
Lila?
Who's the two? What type of scams do we see the most? Well, we see a lot of variety of scams. A lot of ones now we're seeing unemployment scams. Someone's collecting other people's unemployment benefits. The Social Security scam continues to go around. The variations of a grandparent's scam go around where people pretend to be your grandchild or your niece or nephew asking for money. Oh goodness, we get many different kinds of scams. They just seem to change sometimes the premise of the scam is the same, but the scenario is different. I'm trying to think what else in the last few days.
One of the insidious ones we see is people that get in relationships online. They spend a month getting to know a person, and all of a sudden they've fallen in love and they start sending them money. That is like a big red flag. When somebody you met online is asking you for money, just stop right there.
Actually, there was a lady in Howard County that spent over $600,000 to a romance scheme. And
I don't even give
actually, as a credit union, we see it over and over again. It's crazy. It really is.
It's very sad, very sad. People also think they've won prizes. They think they're gonna, if they send, or they send green dot cards, but people don't realize that it's not something you send. Gift cards, people are looking for payment, or that they'll ask you to send those kind of means to get payment. That doesn't happen. Sometimes you've gotten scams where it could be like your employer sends you, they think it's your employer sending you an email to go do something with money, take this, go do this or do that, and it is not your employer, it's just somebody stealing the money, and you send a check to so-and-so or whatever. there are just so many. It's endless. It's just endless. I mean,
I
just
think one of the big ones that you mentioned there, Lila, is the check. If someone sends you a check
a fake
and
check
then
scam.
wants you to send money back,
Yep.
that's just not, there's no reason for them to send you the money to get money back from you.
Exactly.
It
Right.
happens when you put ads in the
I know.
paper to sell something, they'll send you a $600 check for a $300 item. The check
Right.
is worthless, but you
Check's
don't know
worthless.
that. You
So
deposit
until
the
it
check,
bounces.
send them $300 back, and you're now out both
Right.
the thing you sold as well as the money that you
Right.
sent back to them. So it's you owe to your bank the whole $600 check that you know,
Right.
that
Right.
was not
Because
good. So
you're good.
don't ever trust a check sent to you
No.
and someone's asking you to send money back.
Right.
And I'll just build
Exactly.
upon that, David. Some of the scams that we have seen or that I've heard about are, for those that are using Venmo, you'll see something that's deposited into your Venmo and say, oh, I'm sorry, I didn't mean to send that to you. Can you refund me? Anything that sounds that it just doesn't sound right. And of course, that's the scam, is that they've stolen someone's credit card. They've given you the money. Now they're saying, that's I apologize, sent it to the wrong account. Can you can you refund me? Here's my
Right.
information. And then of course, by then, you're out, and then you still may have to pay the other person back. So just beware of those two. And what I always tell constituents that reach out to the executive's office, and I'm sure Lila will echo this, is if there's something that just doesn't seem right, they're asking information where they should already have that information. As David mentioned, if they're asking for account numbers or passwords, that should raise that kind of red flag that you don't want to provide that information. And of course,
Exactly.
when in doubt, I always refer constituents to our Office of Consumer Protection. Lila is one of the investigators there. Lila, if you wouldn't mind just putting your contact information in the chat box.
I did.
You
I
can, I'm
did.
going to try and go on memory, but it's consumer@howardcountymd.gov. And I believe the
That's it.
phone number is 410-313-6420. I hope I got that right. I've certainly referred
did.
enough people to you.
You did. You got it right. Got it right.
And Kim,
Um,
and I'll just add that, there's a week in June that's called Protect Week, where we focus on the financial exploitation of older Americans. And it's all about scams. And the biggest drive of that week is to just get people to know what scams are.
Right.
Because the more you know, the easier it is to protect yourself. And the first time I was involved in that week and helping with the content and the publicity of it, I sat down with my in-laws and I said, okay, from now on, I go through all your mail. Like you don't respond to anything until I've taken a peek at it. But I'm going to put the Protect Week website in the chat as well, because it is an evergreen site that's always running. And there's some really good videos on there that the state has made, different agencies have made on the different scams that Lila talked about, that bring it home of what these really are and how bad these can really be.
Actually, June is the Elder Abuse Awareness Month, and we will be doing something here in Howard County. We'll be doing something in the Office on Aging. We'll be doing an event that week. I will be doing a presentation on probably fraud, scams, and frauds as well. Be looking out for that. But scams keep coming. They do. And then there's COVID scams. I mean, if you look on our website, if you go to howardcountymd.gov/consumer, there is consumerism and during COVID and consumerism. There's those scams that are up there. We do have a scam page, and we have links to various current scams.
Thanks, Lila. I'll probably be promoting some of your events.
Yeah.
And we'll just pause right here just in case anyone has any last minute questions. If you don't feel like typing and you want to raise your hand, you can certainly raise your hand and we'll unmute you. And while we wait for those that may not have put their contact information in the chat box, if you can put your information in the chat box. So if folks want to connect with you offline, we can do that as well. And can everyone still hear me? Okay. But my contact information is in the chat box as well. If you just scroll all the way to the top, if you have any questions or want to be connected with anyone or need any resources, you can always feel free to contact me.
Latasha, do you have a question? Oh, she can't unmute herself because she was
Orson,
muted.
are you able to unmute her?
Hello?
Hi,
Hi.
Latasha.
Oh, okay. I was like, wow, I got to go the whole class. Nobody can hear me. So I'm working on my credit right now. And while we're just trying to make some, some basic decisions on uh, like $1,000 to a financial lender, like one of the loan places you go to, and they loan you money, and I didn't pay them back, and I accrued like some interest on the loan, and it got up to $2,000 now, and it's making my credit look bad. So I was wondering, should I just, with the extra money that I've received, should I just go ahead and take $1,000 of that money and give it to them, or should I split the 1,000 in half, give them 5, and give my bank loan 5, because I'm in good standing with my bank, with my loan with my bank, but I'm not in good standing with the loan from that financial institution. That, I mean, it's not, but I don't know. You know, the loaners, the little loaner places you go to. So I'm not sure how to do that, or should I just give them both $100 and say, look, I'm getting started, instead of giving them both a big chunk of my money, like 500 a piece? How should I do that? To just to, just not just to give them money, but to build my credit score, because it's making my credit score look bad.
Yeah, I'll be honest, it's hard to give advice without having the whole picture. Now I have like 100 questions, but you want to make sure that if you have obligations, you're meeting them as best you can. So if you're in good standing with the bank, and whether it's 500 or whatever you need to keep making your minimum payments there, as long as you're meeting that obligation, then the remainder is really just what you want to do with it. I mean, the only thing that'll probably put you in really good standing with the other loan is paying it off at this point, probably. So the more you can put towards it, the better, but don't sacrifice keeping up with your other minimum payments that you have.
Okay, so I'll just do that. I'll just give the okay, I'll just do that. And can I ask one more question, if you don't mind?
Sure.
Do you guys know about Community Reinvestment Act? And is the numbers for bank loans for small businesses small business startups, are they going up?
The General Community Reinvestment Act, it governs banks and requires them to make loans in the communities they take deposits from. But I don't know the numbers on whether loans to small businesses are necessarily going up right now. During the pandemic, there was a lot of the PPP loans being made, but those were not startup loans. So I'm not familiar with any data on what the direction of actual small loans are. Startup loans are those are rare, actually. A lot of banks don't get involved in startup loans. You usually have to have some other collateral to give, or personal credit to get a small amount to start a business with, because there's no track record for the business yet. And so, they'll look for home equity, or somebody that has some other income that they can count on to make a loan with, and then if you choose to use that to start your business. So I don't know the numbers on startup loans.
Oh, what does PPP stand for?
That's the
I think it's personal
the
protective
government's
program.
thing in response to COVID, and we don't do them, so I apologize, I'm not as familiar, but it's the Paycheck Protection Program, and it was designed to give small businesses money to make sure they could keep employing people instead of laying them off when their business, took a downturn with the COVID.
Okay. Let me write that down. And you said the PPP stands for what again? I'm sorry.
Paycheck Protection Program.
Okay, Paycheck Protection Program.
But I
Thank you.
think most of those funds have been lent out at this point. I don't know that they're making any new ones.
Oh, okay. I'm just asking these type of questions because, I'm in this program called Getting Ahead, and we're trying to figure out, our credit versus, being in poverty, and how does credit and loans and different things impact the general community, and how does it continue the cycle of poverty?
Yeah.
So, it's just, some basic stuff I'm asking.
Yeah, and it's great questions, and that is, personally one of my biggest concerns, and why I love being involved in financial education, is for that, to break that cycle. And feel free to reach out to me, and I'm sure any of us tonight. But CCCSMD, we do a lot of education and outreach. So if you want to shoot me an email, maybe we can talk about what other webinars might be good for your group.
Okay, so okay, well, how do I get in contact with you again? I'm sorry.
I'll put it in the chat again.
Okay, because I'm not good with this technology piece, so it'd be hard for me to see. And I can't see. Can you guys see me?
No,
No.
we can't see you.
Okay. Okay, it's hard for me to see and stuff, so I can't. It's a lot of small print here, and it's hard for me to catch the the information that you guys are flashing.
If you go to
see the chat?
cccsmd.org, I think that's probably, you'll be able to find the contact information if you just go to their website.
Okay,
Yes.
cool. Got
And
it.
the phone number that I'm reading out of the chat is 1-800
Uh-huh.
642 2227.
Thanks, Kim.
Okay. And that's how I can catch Emily?
I'll give you my email address. It's Hickox, HICKOX @cccsmd.org. 3
Okay.
C's. That's the most important thing. 3 C's. I have to say all the time.
Oh, I'm glad you said that. ccccsmd.org. Yeah. So I don't know how many other people have questions or whatnot, but we was trying to figure out, does more credit unions and banks offer fair loans to low wage workers?
I'm trying to figure out your question. Are you comparing the credit unions or banks, or are you saying are more banks trying to make those loans to low-wage workers?
Yeah, because that's a part of like the poverty line and stuff like that for people who are low wage workers and stuff like that. Are the credit unions, we trying to find out, are the credit unions and banks even offering them, you know what I'm saying, fair loans and stuff?
Yeah, I would say typically your credit unions are making an effort to make loans in relationship to your income. So even, if you have a lot of credit unions will make a $200 or $300 loan that a lot of other institutions that are for profit won't make because they don't make money on it, but the credit unions will make that small loan. The problem is if you're looking for a $10,000 personal loan and you only make $10,000 a year, that just isn't an equation that's going to put you in a good position. So the bank or the credit union won't make a large loan, personal, but a car loan, certainly we make a lot of low wage loans to, for people for cars and things like that.
Okay. And you are, I'm sorry, Mr. Woodruff, right?
Yeah.
You are like working at a financial institution, or what is your?
Yeah, I'm at APL Federal Credit Union. We serve Howard County.
Okay, you like the director there, huh?
Yeah, I'm the president of the credit union.
Oh, wow. So here I am interviewing the president of the credit. It's exciting to me because not only did I get information from you guys' class tonight, but it's information I can take back to my other group. It's called Getting Ahead. And there's incentives, with being in that group. At the end of the group, we get $600. And, I didn't realize that, but I told them to take the money and put it towards my, towards what I owe the university. I go to Morgan State. So I had asked them to put it towards I owed $1,300 on my calculus class and stuff. So I was trying to find ways to help, but the class is very informative. It's teaching us a lot of things that make us do self-assessments, and, not just the self-assessments are geared towards, social capital. It's social capital assessment, language resource assessment, mental resource assessment, emotional resources assessment. And when it's, like, just to give you an example of emotional resource assessment, that goes into detail with, am I having trouble naming and feeling? I often lose my temper. I often feel anxiety or depression. It goes into like, I seldom get into unusual, just the same thing. It's just a cycle of, how you feel and different things like that. You're self-assessing, you have financial resources, like it tells you to assess yourself on financial resources, which goes into detail about, members of our household have been homeless or have doubled up with others who are not related to us in order to make ends meet. My family uses one or more government subsidies, subsidies such as cash assistance, food stamps, medical card, energy. Um, and the description of it is like, doesn't have enough income to purchase needed goods and services. And it asks you why. And, it just goes into a lot of details that I can't really hold up the class to talk about. But, you guys are giving me good information to take back and, try to elaborate on a little bit of, what I've gained from, just from exposing myself to you guys. So
I'm Googling it. It's
I
very
really thank you.
And Natasha,
Uh-huh.
we're glad that you tuned in and you found this workshop really helpful. I will say I'm gonna turn it over. We have one last question that I see from the chat box, and that might be kind of my last closing point. We have someone that asked, wonderful information. Do you have anything that could be shared on Facebook on your programming? Keep in mind, our Money Matters workshop is held during the month of April, which is when we celebrate Financial Literacy Month. If you're not already following the county executive on social media, every Monday, the county executive puts out a Money Matters Monday. Each week during the month is dedicated to a certain theme. This week is particularly dedicated to credit and identity theft. And so most of the workshops we have are focused on that. Once we finish our workshops, we then upload it to our Money Matters website, and that's found on the county's website at www.howardcountymd.gov. Now, typically at the end of the week, the county executive does put out the flyer for the next week. So I can't remember whether it was Friday or Saturday, but we put out the flyer. And then, of course, involved in helping make the Money Matters workshops happen is our Money Matters planning team. And that's made up of CCCSMD, Making Change, our Office of Consumer Protection, our housing folks, Housing Commission, Department of Housing and Community Development. So wonderful partners, and I'm confident they're also sharing that information. But I will say one of the challenges is just reaching everyone. Are you connected with them? So we will always endeavor to improve upon our marketing. And for those that are still tuning in with us, if there's particular ways that you receive your news, right, or information about upcoming workshops, send me an email or give me a call just so that we can make sure that as other workshops come up, if you're a member of a particular group or you live in a particular village, that we're being very mindful of kind of our outreach efforts. My phone number is 410-313-2013. And my email is P as in Peter, R UIM as in Mary at howardcountymd.gov. And unless I see any other hands raised, I am truly thankful for all of those that tuned in tonight. And thank you so much to all of our presenters. You did a wonderful job. And that's going to conclude our presentation this evening. Have a wonderful night.
Thank you, Kim.